Hello chaps, welcome to Bar Snacks. This is the channel all about finance, economics, business, politics and policy. And today I'm going to be talking about a specific stock that I'm quite interested in and the company behind it, and that's Berkshire Hathaway. I first got into Berkshire Hathaway because I searched up, like anyone would, what's the most expensive stock you can buy? Out of all of them, which one's the most expensive? And the answer is Berkshire Hathaway Class A stock, which is currently at $297,547 a share. Now that's a lot, and we'll see why later, but first let's just dive into the history of Berkshire Hathaway. Berkshire Hathaway actually wasn't originally an investment fund. It was originally a textile manufacturing plant that was controlled by Warren Buffett. It was only when Buffett started using revenue to invest in other companies did it become an investment fund, and eventually the investment became more important than the original manufacturing, and it became the Berkshire Hathaway investment fund that we know today. Now let's get into some of the companies that Berkshire Hathaway fully owns. We have Geico, Dairy Queen, Fruit of the Loom, etc. These are well-known brands that he owns entirely. Berkshire Hathaway also has large stakes in Wells Fargo, worth $29.28 billion, Apple, worth $28.21 billion, Bank of America, worth $20.66 billion, Coca-Cola, worth $18.35 billion, and American Express, worth $15.06 billion. So none of these are particularly weird stocks. They're all very mainstream. They're all very popular stocks. And he just owns a lot of them. And this has to do a lot with his, by him I mean Warren Buffett's, investment philosophy, which we'll get back to at the end. But first I'm going to talk about the details of Berkshire Hathaway stock, because unlike other stocks, it's actually quite different and interesting. Because Berkshire Hathaway doesn't just have one stock representing a company, like Alphabet or Apple or Microsoft or any other company does. They actually have two different kinds of stocks, Class A and Class B. Class A, as I previously mentioned, is the very expensive one at about $300,000 a share. But Class B is a lot cheaper. It's currently at $198.78 per share. The reason there's two kinds of stock is because originally there was only Class A stock. And because it was so highly priced, it wasn't very accessible to the major market. In order to get more investment flowing through into his company, what Warren Buffett did was take Class A shares and essentially split them into divisions worth less. So originally, one Class A share would be divided into 30 Class B shares. It's good to note that as well as being a 30th of the equity, they were also originally a 30th of the price. But they're not necessarily that way currently, and we'll get back to that. In 2010, Class B shares were split again. So instead of being 1/30th, they got a 50-to-1 stock split, which is absolutely huge, and became 1/1500th of a Class A share. When there were only Class A shares, the stock wasn't hugely accessible. So what happened instead, if people want to invest in Berkshire but didn't want to invest that heavily into Berkshire, what they could do is instead invest in a mutual fund, which was basically a lot of people got together and put in money, a mutual fund that mirrored the exact same holdings that Berkshire had. And because Warren Buffett didn't want that, it wasn't beneficial to his business. He instead split up the shares, so that's why he started splitting these up. So 1,500 Class B shares became worth one Class A share in price and equity. And we can kind of see how that relates if we just do the maths here. So $198.78 times 1,500 is $298,170. Now that's pretty close to 297,547, which is what Class A is currently at. But it's not exactly the same. And the reason for that is though these shares both represent the exact same business, the market for them, like the kind of people who invest in them and the kind of feeling they have about them, is different. So they do perform slightly differently. Class A generally outperforms Class B, but that's certainly no guarantee. It's just subtle differences in the market mechanism that don't keep them from being perfectly even in price and equity. So Class A and Class B shares are really tailored for different people. There are some benefits to both. Firstly, with the performance, Class A generally outperforms. But it's a really long-term investment because you've invested so much money. you're really looking to get profits in the long term. Whereas Class B, it's a bit more volatile, but it is cheaper. So if you don't have that kind of like money to invest in, you can still get a slice of the Berkshire Hathaway pie for relatively cheap, $200 a share. Also, Class B has more liquidity. So let's say I had only Class A shares and I just wanted to sell some for the cash for me. Well, now my profits are divided up into huge blocks of $300,000. Whereas if I invest in Class B shares, they're broken up into $200. So I can definitely control how much money I want in and out of Berkshire Hathaway, and it's more liquid like that. So there are some benefits to both Class A and Class B. So when you hear about these stock splits and things like this, you could ask yourself, why doesn't Warren Buffett split stocks further? After all, if you split a stock, that's making it more accessible because it becomes cheaper and more people can invest in it. So why doesn't Warren Buffett just keep splitting the stock further and further and further? And this actually has to do with Warren Buffett's own investment philosophy. Basically, what Buffett did was he invested large amounts in a few trusted companies and held them for elongated periods of time. Not like a day-to-day investor who is just trying to make a quick profit on the day. He invested in companies that he trusted, that he looked at, and then over time he held those companies, and he's just become extremely successful doing this. And the reason why he doesn't split Class A shares has to do with this. It's because it's about his own philosophy. He believes that a Class A share of Berkshire Hathaway is an investment that you can hold over time, a trusted investment, and at the end of a really long term make your solid profits. Warren Buffett was actually massively influenced by the investor Benjamin Graham, who is the author of probably the best investment book of all time, The Intelligent Investor, which I am actually currently reading after doing all this research. And essentially, from what he was told in this book, he came up with his philosophy, and he's been doing it ever since. Anyway, that's it for now about Berkshire Hathaway and its stocks. If I find any more interesting stocks, I'll be sure to share them on this channel. But for now, this has been Bar Snacks. See you in the next chapter.